Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of May 12th. Thank you for joining us. We're glad you took the time to check out the video. Also, don't forget, if you find these videos helpful or informative, go ahead and like and subscribe to the channel and check out some of our other great content at the same time. So as usual, the purpose behind these videos is to use my background in economics to help you better understand the financial markets and the economy so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as usual, let's start by taking a look back at last week. Now, I wouldn't say last week was a good week, but I would say it definitely wasn't a bad week. And to get the conversation started, we can take a look at jobs. So the weekly unemployment insurance program actually indicated two dropping values. Both the initial claims and the continuing claims dropped back into what we've seen as their normal operating range over the last few months. Also, on a somewhat more positive note, we saw the Federal Open Market Committee, which is essentially the Federal Reserve, decide not to change interest rates. So this is in line with what most economists and most analysts had expected for this meeting. But it's important to note two things from the press conference. The first is that the Federal Reserve explicitly mentioned in their statement the increased and continuing uncertainty and the increased upside risk to both inflation and unemployment. But with the caveat that the hard data currently still signifies a relatively strong economy. The jobs situation is relatively low unemployment. Inflation actually fell in the most recent report and seems to be relatively stable, slightly higher than the 2% target. And the economic slowdown that many are speculating may occur because of tariffs hasn't started to show up in the data yet. The Federal Reserve sees themselves in a good place, in a strong place, to respond to any changes in the economy, albeit in the near term or the long term. They have plenty of policy room in their interest rates to cut rates or to hold rates higher for longer if necessary. So the Federal Reserve is optimistic that they're in a good position to wait and see how the effect of the new Trump administration policies and tariffs will actually impact the economy. This has also led to speculation as to how many interest rate cuts may occur in 2025. The Federal Reserve is still planning or is still explicitly talking about 2 interest rate cuts. The markets seem to be pricing in 3 interest rate cuts. But what we've seen recently is that the interest rate reductions have been pushed back, with speculation leaning on July as the first cut and potentially September being the first cut, and the September, November, and December meetings being where we see the significant reduction. It is possible, though, and the range of predicted possible values for the Fed funds rate spans from 0 basis point cuts in 2025 all the way up to 125 basis point cuts. It's really a function of whether the inflation comes back and whether unemployment starts to climb in response to economic slowdowns resulting from tariffs. Switching our attention over to the economic data, we saw the trade balance for the month of March worsen significantly, ultimately just reflecting the massive increase in imports in the month of March, as both consumers and companies tried to preempt the introduction of tariffs that we expected in the month of April. We also saw consumer credit increase slightly for the month of March, but the increase was right in line with the growth that we've seen over previous months in 2025 and close to the end of 2024. Along with the trade balance data for March, we also saw that wholesale inventories increased over the same period, most likely for the same reason, trying to preempt the tariffs. And we saw that unit labor costs and productivity measures both worsened during the same period. Unfortunately, all the commotion around tariffs, all the changes in consumer and business purchasing behavior and expenditure on imports has really kind of muddied the waters as far as the economic data. What we expect to see over the next few months from April on is that as some of the tariff picture becomes more permanent or we see less frequent fluctuation, that we may actually start to see some of the behavior and some of the economic patterns stabilize. Turning our attention to first quarter earnings reports, we saw two big tech reports released last week. The first was Palantir. Palantir actually exceeded expectations as far as their first quarter performance, but in response to significant concern about the very high valuations that they're currently enjoying and unexpected drop in their European sales, the stock actually took a hit for a short period around the middle of the week. AMD, on the other hand, actually produced strong first quarter results and what most analysts consider to be incredibly positive forward guidance for the rest of 2025. Keeping our positive theme going for the week, Disney, Electronic Arts, and Uber all posted strong first quarter performance and what most analysts believe was optimistic forward guidance for the rest of 2025. Of course, the one blemish in that same consumer-facing group was the Ford Motor Company. Ford Motor Company performed relatively well in the first quarter, but pulled its forward guidance entirely, specifically stating concerns around the proposed $2.5 billion impact of tariff costs and potential high levels of unpredictability and uncertainty in the automobile and import markets moving forwards. Taking a look at the energy and utility sectors, we saw Williams Companies and ConocoPhillips in the energy sector, and we saw Duke Energy, Constellation Energy, and American Electric Power all producing positive first quarter performance as far as earnings and revenues, and all posting relatively optimistic forward guidance. Taking a look at the stock market, the S&P 500, Dow Jones Industrial Average, and NASDAQ stock indices all finished the week essentially flat. Some big ups and some big downs throughout the week, but we saw what feels like a renewed sense of optimism and maybe risk-on trading behavior. Specifically, there was some optimism around the potential for a US-UK trade deal later in the week. There was a renewed optimism for the potential of a de-escalation of trade conflict with China. And some of the more risk-favoring markets, such as Bitcoin, actually saw significant inflows throughout the week. So with that in mind, it's quite possible the markets are overly optimistic right now, or that this may actually be a short-lived optimism, as this week may present some new information and a shift in attitudes. But as always, we can only take what we know, take what we're given. And I think a little bit of optimism last week was a nice change from the last few months of growing pessimism and concern. Taking a look over at the fixed income side, we saw the yield on the 10-year Treasury increase throughout the week. In fact, reaching almost 4.4% on Thursday, which is the highest level we've seen in several weeks. Again, keep in mind that when yields on the 10-year Treasury are climbing, it means that the price of bonds is falling. Or essentially, we could imagine it as a sell-off in the 10-year Treasury market. So it's possible that these climbing yields were actually a function of the potential trade deals with the US and UK, and as well as a reflection of maybe some of the greater optimism we saw last week in the markets more generally. Along those same lines, we also saw a slight recovery in the value of the dollar. Although it wasn't a massive change, we saw some upward movement, especially on Thursday, after the announcement of the US-UK trade deal. And it's possible that if trade tensions are reduced and global economic growth estimates rise, we could see continued increase in the value of the dollar. Taking a minute to look at some of our alternative markets, Bitcoin had an absolutely fantastic week. We saw Bitcoin gain almost 10% in the last 5 days. Over the last month, Bitcoin has gained approximately 25%. And we saw Bitcoin reaching levels that we haven't seen since much earlier in the year, ending the week around approximately $103,000 a coin. On the crude oil side, we saw some early struggle in the crude oil market, but ultimately the general sense of optimism around trade and around global trade deals actually pushed some upward pressure on the price of crude oil, and we saw a significant increase by the end of the week, exceeding 3%. Last of all, we saw the price of gold fluctuate throughout the week, ultimately seeing a slight gain by the end of the week, but as the risk profile and the risk aversion of investors in the market changed, we saw the value of Bitcoin rising, the value of gold dropping, which are both normal and predictable or expected reactions to an environment with more optimism and more of an appetite for risk. Turning our attention to this week and the week ahead, it'll actually be a relatively quiet week as far as first quarter earnings reports. We'll see reports from Cisco Systems, Walmart, and John Deere parent, Deere & Company. But other than that, we'll only expect to see about 10 earnings reports from the S&P 500. So the two big stories this week are inflation and consumer sentiment. On the inflation front, we're going to see data this week from the Consumer Price Index, the Producer Price Index, and the Import-Export Price Indexes. All three of these are incredibly important. As we all know, the effect of tariffs are making their way through the economy. And the big question is, when do we start to see those effects show up in the data? So consumer and producer prices, we will most likely see the effects of tariffs. We may see some early effects in these reports, but we most likely won't see those effects in full magnitude until the reports for June and July. But the Import-Export Price Index is incredibly insightful and important for the month of April and May, because one of the suggestions of the Trump administration is that the introduction of tariffs will cause foreign producers to lower their prices to help offset the cost and protect their market share of the increased import taxes. Import and export prices is where we would expect to see this show up if it does occur. We didn't really see it occur in 2018, 2019 in the last trade war, but it is one potential observation, one potential question that the Import-Export Price Index could answer for us this week. As far as consumer sentiment, we've seen consumer sentiment deteriorating over the last 4 months. The big question is whether April will be the 5th month. This is the preliminary report, which ultimately means it's going to capture a lot of insight from the beginning of the month. But the big question is whether we see an ongoing significant deterioration or more of a stabilization in consumer concerns around things like inflation, household income, and employment. Also this week, we'll see our weekly unemployment insurance claims, the big question being whether these claims continue to fluctuate within their recent normal range or if we start to see some deviation. The labor market seems to be one of the most important linchpins in holding this economy together and avoiding some of the more drastic slowdown that folks are concerned about. So, as we look through these unemployment reports, the insight will be, do we see deterioration or do we see continued ongoing strength? Rounding out the economic data for this week, we'll see some information in the housing market, including the National Association of Home Builders Housing Market Index. We'll also see information on manufacturing, including the New York and Philadelphia manufacturing surveys, as well as the industrial production and capacity utilization reports for last month. We'll also see business inventories and retail sales data later in the week. And on top of all these economic pieces of information, we will see another report on the current budget of the federal government and a report from the Treasury on where we stand as far as the deficit. Turning our attention a little further in the future, looking through this week into what might be coming, unfortunately, it's anybody's guess at this point. There are some legitimate, tangible reasons to be concerned about more inflation and higher unemployment and a potential economic slowdown in the future. But at the same time, we saw the first of what could be many trade deals put in place with the US-UK trade deal last week. And it is possible that if these trade deals do start to fall in place and the Trump administration reduces the threat of tariffs in some significant manner, that we could actually see a return to relative normalcy as far as the economy is concerned. The bottom line is there's just too much uncertainty to really know what the future holds until we find ourselves in it, until it's upon us. So with that in mind, I just want to take a minute to remind you, this is what we do best. We watch the markets, we read the economic reports, we sift through the data, and we do our best to bring you the most important information in an easy to understand format so that you can make informed decisions and stay up to speed on the markets. So with that in mind, as the economy moves forward, lurches forward 1 week at a time, I want to thank you for joining us this week. And I want to encourage you to come back and check out the video next week and use our research and our summaries to help stay up to speed on the markets. So along those lines, thank you for joining us. Good luck this week, and we'll see you next week.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.